So I think we are live now. Yep. Hello students and welcome back to BankExamsToday.com, and today we are going to do important questions for PNB, SO credit and risk manager. These topics are very important for credit risk, even for the treasury officer, treasury manager. These topics are very important. This is a common topic for all that all the streams in PNB SO. But very important for credit risk and the treasury. So that's what we are going to do today. 10 important questions that I'm going to share, exam relevant question. This is a regular MCQ series that I'm going to continue, right? So let me share the link on my Telegram channel. I have already told you that I have started a specific PNB SO credit scale 2 scale 3 Telegram channel. The link to the channel is available in the description. I have already started this channel. There are already 700 members of this Telegram channel, and I recommend you to join this group so that you can get regular updates. So see, I have already updated it, the link to the Telegram channel, and now it's time to send the link to the main channel. So I have already shared it, and now the student will come to the video. So all the students, they got the notification. If there is any doubt in your mind, please ask your doubts. I have already answered most of the doubts regarding the eligibility criteria, but now I guess it's time to do the preparation. And let's start with the question number 1. सीधा question से start करते हैं. It's high time. So let's just start with the question number 1. Which of the following statements most accurately describes a derivative security? What is a derivative security? How a derivative security gets its value? You might have seen gold future, Nifty futures. You might have seen. So what is the main feature of a derivative? Most accurately describe the value of the future is dependent upon the underlying asset. Here it is gold, here it is Nifty. So what is the correct answer? Which of the following statements accurately describes the derivative security? So always increases the risk. Whether derivative always increases the risk. For one person takes a risk, and one person there are two persons. One person gets a premium to take the risk, other person pays a premium because he don't want to take the risk. So this one is always not correct. It has no expiration, it has a fixed expiration, not sure about it. It has a payoff based on a asset value or a underlying asset. The value of the derivative is dependent upon an underlying asset. What is an underlying asset in case of gold future or Nifty futures? In the case of gold futures, the value of gold. In case of Nifty futures, it's the value of Nifty, the present value of Nifty. So the value of underlying assets, right? So that's the value of derivative is dependent upon the value of underlying asset. So it's a payoff, right? So this thing accurately defines it. Okay. So let's move forward to the question number to the next question. First ka C, very good. Now let's move to the question number 2. Let's move on to the question number 2. Let's move on to the question number 2. Which of the following statements about exchange traded derivatives is least accurate? So first of all, students, you need to understand the difference between the exchange traded derivatives, the forward and the future. The exchange traded forward and future. What is the difference between forward and future? You will find at least one question from this particular topic, forward and future. So see students, there are two companies, company A and company B. Company A, let's say Vardhaman, okay. Vardhaman knitting yarn, okay. They need cotton throughout the year, but they don't want to take the risk of the cotton price ऊपर नीचे जाते हैं, right? But they want the cotton at a constant price. They don't want to take the risk. They are not traders. वो उस पे risk नहीं लेना चाहिए. It's not the business of Vardhaman. While there is company B, which is a trading company, उनका ये काम है, ठीक है. So B is taking risk on behalf of Vardhaman, right? So they have done an agreement. So that would be a forward contract. So Vardhaman says, आज cotton is at 50 rupees, and B says, okay, I'll give you the cotton at rupees 51 for next 1 year. Okay, so that is an agreement between Vardhaman and the company B, right? The B would deliver the cotton at the rate of 51. That is a forward contract. If Vardhaman goes to the commodity exchange and buys the future, okay, so he's going to the exchange, commodity exchange. So the person who's taking the risk, there is a middleman, the exchange between the Vardhaman and the company B. They don't know each other directly. Between them, there is an exchange. Obviously, the contracts would be standardized. Gold futures are standardized. Nifty futures are standardized. Lot size hota hai proper. Obviously, the exchanges, they provide the guarantee. There is less chances of default. Default hone ke chance bahut kam hai because exchange is involved with which are guarantor, right? So these are some benefits of future or exchange traded derivatives. So which of the following statements about exchange traded derivative is least accurate? Exchange traded derivatives are liquid. They are standardized. They carry significant, no, they don't carry significant, default risk. They are fixed. Baki theek hai, C mein problem hai. Because see, default risk is a feature of forward contract. Okay. Not the exchange traded future contract. In case of exchange traded contract, the exchange is providing you the credibility. Exchange is providing you the guarantee. So these contracts are credible. Okay, these contracts are credible because exchange is providing you the guarantee. Which of the following derivatives is a forward commitment? Which of the following derivative is a forward commitment? Stock option, interest swap, credit rate swap, forward option, put option. So as I said option, as I said commitment, not option. ये तो option है ना. You bought an option to buy a share at the rate of 50. So this is an option. You can exercise this option or you can just let this option go. So option वाले सबसे पहले cancel. Option is gone. So what about the interest rate swap? What about the interest rate swap? Let's say there are two companies, Z and B. There are two companies, Z and B. Z got a loan at the rate of, let's say, 6%. They got a 5-year loan of same value, 5-year loan of, let's say, 100 crores at 6%. And B got a 5-year loan of rupees 100 crore at MIBOR, plus MIBOR is a standardized, I mean, I would teach that in another class. It's a long class. MIBOR, it's a standard, plus 1% or 100 basis point. Z wanted, that is a flexible interest rate, that is a fixed interest rate. B wanted to have a fixed interest rate while Z wanted a flexible interest rate. So what B did, okay, now there will be exchange of the cash flows from B to Z. There would be an exchange of cash flows from B to Z. That is an interest rate swap. So interest rate swap is a commitment because, there is a commitment of future cash flows. Okay, so that is a commitment. A custom agreement to purchase a specific T bond next Thursday for rupees $1,000. Please, okay. Somebody said Surya ki please ye padho. Okay, sorry. A custom agreement to purchase a specific T bond next Thursday is what? Surya Agarwal. It's time to answer. आपने बोला कि पहले पूछो. Okay. So a custom agreement to purchase a specific T bond next Thursday for $1,000 is an option, is a future contract, is a forward contract, or all of above. Forward commitment, all of above, or none of these. A custom agreement to purchase a T bond next Thursday for $1,000. So tell me the correct answer if you got it. Mumbai Interbank exchange rate, okay. So custom agreement to purchase a specific T bond next Thursday for $1,000 is an option, a future contract, a forward commitment, all of the above, none of these. A custom agreement to purchase a specific T-bond next Thursday for $1,000 is what? It is what? Let me know, students. Somebody said telling me it's a forward commitment. It's correct. So it's a forward commitment. You are committing a custom agreement to purchase specific T-bond next Thursday for $1,000. You are making a commitment. It is not an option. It is a commitment. Okay. Forward commitment. So interest rate swap, I have already explained to you. Two companies, Z and B wala example. This is interest rate swap. What is happening? Cash flows. Regular cash flows are there. So interest rate swaps are highly regulated, equivalent to series of forward contracts. Contract to exchange one asset for another. So there is no exchange of asset. Okay. It is not about highly regulated. It is equivalent. It is not clear. This answer is not clear. Although it's a contract is regulated, but it is not clear. Equivalent to a series of forward contracts. Okay. Every year. I mean, see, let's say if the MIBOR rate goes up and every year there is an agreement. Either Z pays B or B pays Z. Okay, whatever the commitment is. So it is equivalent to a series of forward contracts. So B is the correct answer. A call option is now it's your turn to answer. Right to sell at a specific price. Very easy question. Or please mention the question number 6, 7, whatever. A call option is right to sell, right to buy, an obligation to buy at certain price, all of the above or none of the above. A call option is what? Please give me the correct answer. Water. So a call option is what? Somebody Kimti Singh said B, right to buy at specific price or an obligation. A call option gives the owner right to buy, right to call an asset. It is a right to buy. A call option is a right to, it's a right to buy. It's a right to buy at a specific price. Okay, call option is a right to buy. A put option is a right to sell. A put option is a right to sell when, see, when in the bulls in the market, they expect the prices of a certain security would go up, right? This is the current situation, right? According to you, you have a bullish approach. You know, what bull does, wo sab kuch upar utha ke फेंकता hai, right? So if according to you, the prices of securities are going to go up, according to you, if the prices of securities are going to go up, you are bullish about the market. You are bullish. If you think the prices are going to go down, you are bearish. Bear सब कुछ उठा के नीचे फेंकता है. You are bearish. So according to you, कि यार future में, in the future the prices are gonna go up. Okay. So you, what do you say that at this point of time, right? I would buy the security at this price. Let's say it's 40. I would buy at 40, and this would money I would make. You assume that the price would go here at 50, and I would, let's say 50, 60, whatever, I would make 20 rupees. So that is call option. What you are going to do, you are getting a call option. And here in the call option, in the put option, you are assuming that right now it is 40 rupees and in the future it is going to be 20 rupees. So what you are doing, you are borrowing the share and you are buying a right to sell. You got a right to sell. Okay, you got a right to sell. So according to you, that's how you would make the money. Okay. So at expiration, the exercise value of a put option is what? At expiration, the exercise value of a put option is, well, what? Give me the correct answer. Surya Agarwal for BOI, I'll make a video for sure. Sir, in PNB SO cutoff, focus on the derivatives. Please focus on the derivatives. Give me the answer to the derivatives as of now. I'll discuss the rest of the things tomorrow. Pehle derivatives. So at expiration, the exercise value of a put option is what? Give me the correct answer. Anybody? Somebody is giving me 0. No. The exercise value, it's not. A is the correct answer. See, at expiration, the exercise value, in case of a put option, please remember we are talking about put option. If the market goes down, you'll make money. If you bought a put option and market goes down, you'll make money. So it'll be positive if underlying asset price is less than exercise price. You were assuming that the market would go down and you bought it here. if the underlying asset price is less than, the price at which you purchase, you made this much money. Okay, so positive if underlying asset price is less than the exercise price. At expiration, exercise value of a call option. Now, very simple. I have already explained you. Now, simple situation. This situation is there. According to you, the value of security is going to go up, and here you are. You purchased at this value, and you are going to make money here. So, what does that mean? What is the correct answer? If you know the correct answer, let me know. 7th card D. Somebody is saying no. 7th card D is not. So, if somebody knows the correct answer, at expiration, the exercise value of a call, please watch the complete videos on my course. If you're preparing for PNB Credit Officer, I have a complete course on BankExamsToday.com. Please check. Otherwise, अच्छे से तैयारी करो. So the correct answer is C. I have already explained it to you. The correct answer is C. The greater or of 0 or underlying asset price minus the exercise price. Okay, the greater of 0. See, this value can be here, this value can be here, or this value can be same. Okay, so otherwise, if it is here, obviously that the value of option would be 0. He won't be. So here there would be loss. He won't be exercising that option. वो option को जाने देगा. He won't be making a loss out of it. He already bought the option. If he is making loss at that point of time, he'll let the option go. So either it would be 0, right, or underlying asset price minus the exercise price. ठीक है? So C is the correct answer. An investor writes a put option. Please remember, writes a put option. The person is selling the put option. He is selling the put option. Okay, it's not about right to sell. You are selling a right to sell. Okay, you are selling an option to somebody who has a right to sell a particular security at a specified time, at a specific price to you. I'll give you an example. Today, there is Mr. A, there is Mr. B. So you gave, there is a security whose value is $40 and you gave Mr. B a right. That's C, buddy. You can sell this security. For, let's say, for $42 back to me after 2 months. Okay. So, but for that thing, I'll charge $5 as my commission or as my fee. Okay. So you are selling the right. So let's get back to the question. An investor writes a put option with an exercise price of $40. So you gave an option of $40 when the stock price is 42. So it is not even relevant here. The option premium is $1. At the expiration, the stock price is 37. Obviously, you sold right to somebody. You sold a put option. Obviously, that person would come to you to sell the stocks for $40. At that point, at expiration, the market price is $37, but you gave somebody a right to sell that particular security for $40 to you. आपने बेच दिया right उस time पे, right? कि at after 2 months come back to me and sell this security for $40. According to you, the prices were going to go up, but they went down. So that person would come to you with that and tell you that obviously you said that I could sell 1,000 shares at the rate of $40. So here you go. So you need to buy shares at $40 and you need to sell it in the market for $37. But as you also got a premium of $1. So what you lost 37, $3 loss was there. But as you got a premium of $1, so you made a loss of $2. Okay. So you made a loss of $2. So A is the correct answer. Okay. Next question. Please do it yourself. Derivatives are least likely, very easy question. Now you should do it. You should be able to do it. You should be able to do it. Somebody said C or what? The correct answer. C, students, a lot of you are confused about A and D. Please remember, an investor writes a put option. He sold the right. Okay. He writes the put option. He writes a put option to somebody. He doesn't have a right to sell. Somebody else has a right to sell, right? So उसने बेचा है, वो प्रीमियम लेगा, right? Somebody would come to him. He sold the right. He is the person who sold the right. He doesn't has a right to, sell the security to someone else. इसने दिया है right, ठीक है? So the loss should be $3. The loss should be $3, but he also got a $1 premium, $1 option premium. Why he is taking that risk? So you need to deduct that loss. So $2 is the loss. So please remember that A is the correct answer. Most of you are wrong. ठीक है? $3 is not the loss. $2 is the loss. Derivatives are least. These are very important questions. These are the kind of questions you are going to get in the exam. Exam में यही मिलेगा. Derivatives are least likely to improve liquidity, to provide price information, to prevent arbitrage, all of the above or none of the above. So obviously, improve liquidity and price information, ये करता ही है derivative. Obviously, derivatives improves the liquidity. Obviously, derivatives provide price information, right? So prevent arbitrage. While derivative prices are result of potential arbitrage, but they do not prevent arbitrage. They do not prevent arbitrage. Liquidity price information wala theek hai. They do not prevent arbitrage. Arbitrage is still there. Right now in India, obviously the derivative market is huge, but you might have seen there are arbitrage mutual funds. There are arbitrage mutual funds. वो derivatives होने के बावजूद भी वो है, existing situation में है, तो that is arbitrage is the correct answer. ठीक है? So least likely लिखा है. Please remember it, least likely लिखा है. Arbitrage. What is arbitrage? See, in the market A, you go to market A, in the wholesale market, you go to, you want to buy apples. The price of apples in the same city, the price of apples is, let's say, rupees 500 per crate. In the market B, the price of apples is, let's say, rupees 700 per crate. So what would you do as a, intelligent trader? You would buy the crates of apples from here to here. Obviously, there would be transportation cost. There would be, loading, unloading cost. But see, it's 500 at here. Let's say the cost of transportation and loading, unloading per crate is, let's say, 20 rupees. But still you are making 180 rupees. You'll buy crates here and sell it here. Okay. You'll continue that. You'll continue until, see, you are creating demand here. You are creating a demand here. Okay, and you are creating a supply here. You are creating a demand here and you are creating supply here. Okay, as the demand of apples increases in the A market, okay, the price of apples would increase in market A, and the price of apples would decrease in market B, and you will continue until the point where it won't be profitable for you to do this thing. अभी क्या है कि 580 plus 20 rupees is transportation and all, and you are going here and your cost is 600. Why would you sell it for 600 in the B market? Okay, so 580 here and 600 here. That is why the price of gold is different in many cities, because there are some costs are there. The transportation and other costs are there. Okay, so these are some certain costs. So which would always be there. Taxation is there, transportation is there, a lot of costs are there. That is the only gap. So if you would buy gold from other cities and try to sell it here, anyways the cost would be almost similar. So arbitrage prevents two assets with a identical payoff from selling at different prices. So basically unka price same karna hai. This is the goal. C is the correct answer. Very easy, students. So students, we are doing PNB SO credit and risk manager courses on BankExamsToday.com. I have already done 4 classes on BankExamsToday.com. I'm providing complete video classes, complete coverage of the syllabus is there on BankExamsToday.com, specially designed for PNB SO credit manager, and there is separate course for risk manager. Risk manager and credit manager, separate courses. Links are available in the description. WhatsApp number is there. We are doing daily classes, recorded sessions are there, and this is a live session, live quiz sessions we are doing. Chapter wise quizzes we are doing with the help of videos, notes, and the quizzes we are teaching all the topics. Interview preparation guidance is there, and we focus on the conceptual understanding of all the subjects. So link to join the course is available in the description. List of students who cracked RRB Scale 2, Scale 3, Bank of Maharashtra Journalist Officer, Bank of Baroda Wealth Management, Vijaya Bank Credit Officer, Bank of India Credit Officer. All these students that took our courses and they cracked their respective exams. I'm really happy for them. So that's all for today, students. Thank you and have a very nice day. Please join. You can join the course on BankExamsToday.com. If there is any doubt, you can always ask your doubts in the super chat or on the comment section. Or you can WhatsApp me or you can go to the discussion boards. It's very easy to contact me. So that's all for today, students. Thank you and have a very nice day. I hope you like the today's session. If you like the today's session, please click the like button and press the subscribe button as well. That's all for today, students. Thank you and have a very nice day. Bye bye.